Major funding for these broadcasts has been provided by grants from New York Community Bank, AmTrust Title Insurance Company, Perfect Building Maintenance, M&T Bank, Customers Bank, Marks Paneth LLP, Capital One Bank, Collins Building Services, Meridian Capital Group. Additional support has been provided by grants from AKA Hotel Residences Corman Communities, Ariel Property Advisors, Amerant Bank, Bank of America Merrill Lynch, Briarwood Organization, Chase Commercial Mortgage Lending, Chase Commercial Term Lending, Citizens Bank, Dime Community Bank, Douglaston Development Levine Builders, Flushing Bank, Friedman LLP, Handro Properties LLC, Handler Real Estate Organization, Hodges Ward Elliott INC, Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, John Casamatides Red Apple Group, Keysight Capital Partners, Matone Group, New Banks, Newmark Knight Frank, Ocean First Bank, Optimum Window Manufacturing Corp., People's United Bank, Rockefeller Group, Rosewood Realty Services, Stonehenge NYC, SVN CPEX Real Estate Services, Tierra CRG, the Marengo Family Foundation, and these friends. Oh, Crystal Apple, you seem bright, but I don't know after the end of this show if you're going to be bright or dull. So today we're going to discuss the outlook for 2020, and I've assembled these three individuals, or should we say characters, to discuss their thoughts on the market. My guests include my buddy over there, David Schechtman, who's the Senior Executive Managing Director at Meridian Investment Sales. Dan Parker, who's the Managing Director, not Senior Managing Director, at Hodges Ward Elliott. The next one is Kent Swig, President of Swig Equities, President of Hemsley Spear, Principal at Halstead, Principal of Brown Harris Stevens, and also President of Falcon Pacific. So, Mr. Schechtman, where do you see the market? Is 2020 going to be a good year? Are you going to be still upset about the June 14th, 2019 effect on residential rental? Where do you see the world?
You know, the great thing about working in New York is there's always a new entrant and there's always demand, and buildings trade hand. And for us folks who are transactional, there's always, fortunately, money to be made. But I see 2020 largely as the year when the market and all the players in the market react. They react to two major events last year. One was the draconian and misguided legislation which was passed in mid-June, which is obviously having a tremendous effect on the residential market. And the other massive event that we had last year was New York City's rejection of Amazon in Long Island City. And I think what 2020 is going to bring is going to bring finally the dust is going to settle, and we're going to see how people redefine pricing and sentiment in the New York market.
Dan?
So I'm naturally an optimist, and I see a lot of opportunity in the value add space, but I have to agree that this is the year in which the market has been digesting and figuring out what to do with the rent stabilized changes. And I think that sellers, especially families who maybe have the basis that gives them the ability to sell into this market, some of them are starting to say, this is the moment that we're going to sell.
I know that you had an involvement in Queens last year.
Mm-hmm.
What effect has that had on the Long Island City market in your mind?
So we sold one QPS last year. It closed actually in late 18, but then, I think we were active in that market. And I think that what you're seeing is probably there was a lot of hope that the Amazon was going to revive the office market over there and was going to continue to bring the rent growth that everybody's anticipating. Despite what happened, every apartment building over there is full of tenants. They're paying top rents. And now they're all talking about their commute to Hudson Yards on the 7 train that'll take them over to Facebook. So Long Island City still has a very good story. I think that as quickly as we were excited about Amazon, suddenly at the end of 2020, it was all about Facebook, the expansion of Apple. The tech industry taking over the West Side like that is really, really something else.
And even, the Hudson Yards area, with the St. John's building and also the new property for Disney over there on Hudson Square. Now, somebody who's been here on my show, who was a visionary on FIDI many years ago, I think he coined the FIDI district, was Ken Swig. How do you see Lower Manhattan? How do you see the market in general?
Well, Lower Manhattan last year, if you look at the area, led in leasing in terms of absorption, one of the few places that actually had positive absorption. Activity was very strong there. There are more condos being built there in project development, not in terms of units, not necessarily in terms of projects. So it's growing. It's a strong place. It's a 24-hour activity area. So from that perspective, I'm positive.
We have too much condo inventory on the market right now. So building new condos in the financial district is not that great because it's going to take a couple of years to absorb.
Well, if you look at the condo market in New York City, last year saw an increase of over 42% of closings over the year before. Going forward on new deals, we were down just a shade. So we'll see what happens. But I would say that there are a lot of condos being built, yes, but one of the things that we're going on more is that the overall transaction volume of New York City, particularly Manhattan, had receded last year compared to the average of what it was. Last year was about the same as 2018, and a little bit more than a low point was of 2009. So we've got too much supply coming on, potentially, of some new condo development, but it's not necessarily just Lower Manhattan.
I would add that one of the unintended consequences of the June laws that I think helps the condo market that would predict that the next decade is going to be better than the last decade is that conversions are virtually impossible now. So all condo supply is going to have to come from new construction.
Right, the 51% rule changes
everything. Markets like the Upper West Side, we looked at the last 40 years. In the data, it shows 85% of for-sale housing on the Upper West Side came from conversions. Only 15% came from new construction. It's just impossible to find sites on the Upper West Side. So the next decade should be good for certain markets of Manhattan where it's all come from conversion.
In the green room, you were talking about the change of the law with regard to the 70-30. Want to discuss that?
Well, the 70-30 rule on Affordable New York program that encourages affordable development, which I think we all agree as New Yorkers, we need more affordable housing, we want more affordable housing, but we need a program that truly incentivizes it. I think that what's missing, and one of the other unintended consequences of the law change, is that now a unit in a 70-30 New York affordable building that leases for less than $27.70, which is probably a typical studio in the boroughs and many one-bedrooms in the boroughs, those are rent stabilized. The deal developers made was that those would be free market units.
If they were over $27.70.
If they were over $27.70. But at that time they made the deal, there was deregulation, there was a 20% vacancy bonus, it was reasonable. The unintended consequence of the law was that all those units in those buildings that were leased for less than $27.70 suddenly went from free market to rent stabilized. Forever.
So let's talk about what happened with regard to valuations.
I always think it's helpful to give real-time examples. 60 days after the laws were passed, our firm, along with 2 other firms, were invited to speak with a family that's been in business in New York. They were builders after they emigrated from Eastern Europe. They built 1,100 units in the late 1920s, call it the Mott Haven section of the Bronx. And they have not sold a single unit for nearly 100 years. These are for-rent units. They're almost exclusively rent stabilized, both rent controlled and rent stabilized. The family has been wonderful citizens of New York. The buildings are in pristine condition. There are all kinds of community programs. They've given back. They're just the ideal New York owners. After 100 years of ownership, this family sought 3 broker opinions of value because in light of the new laws, they've decided to divest themselves 100% of their holdings in New York. When colleagues of mine and my competitors also on this deal, we actually all got to speaking, we all came up with values which were just under 30% of what these buildings would have traded for a year and a half ago. And I think to Daniel's point, there's a realization by owners who have the financial wherewithal, if they make the decision to sell, they're accepting this new paradigm, this new pricing paradigm. And that's kind of a segue into a point that I think is important regarding the market outlook. As the market has changed, just because we've had a wonderful run from 2010 to 2017, part of the reason why there's a decrescendo is just the cycle. Real estate cycles are anywhere from 7 to 12 years. What started happening 2 years ago, especially with the changes in retail, was professional real estate owners, folks who buy and sell and deal in goods of the kind. They realized that leasing prices would change and therefore sales prices would change. They stopped in 2017-18, volume dropped precipitously, and we saw a bounce back in 2019. What always takes a little bit longer, and what most people don't realize, your viewers certainly do, most of New York commercial buildings, which are defined by any edifice with more than 4 residential units or exclusively for commercial or retail use, most of those buildings are not owned by large companies. There are a ton of one-off and private family owners. They have been hearing nothing but negative news, from Amazon to our 51 city council members and some of the wacky legislation they've proposed. We finally have the layperson and the general media, not just the real estate press, explaining to them that the world has shifted. What we've started to see by Q2 of 2019, and I really expect this to take hold this year, is the average property owner recognizes the values that they believed in from 14, 15, 16, 17 are now down here. And some of those people are going to transact.
So you initially started this with the 1,100 units. So how much have the 1,100 units decreased in value?
Those 1,100 units, we gave them a number that was about 33% below where it would have been 24 months ago. We sold the first 4 buildings inside of 10 weeks, hard non-refundable, the first several hundred units for $36 million. The problem there was the buyer pool was as thin as I've ever seen for well-maintained, really, really well-maintained multifamily buildings in the Bronx. It was 7 times the gross rent multiple. 24 months ago, it was 11 or 12 times the gross rent multiple.
I'm hearing about the residential. You know, when we're talking about the real estate market, we have four or five different asset classes. The office market, Kent, how was it last year?
On a volume basis for leasing, it was one of the best years that we've had. You know, it depended on who you look at, anywhere from 43 million to 46 million square feet changed hands. However, the absorption rate was in the negative over 3 million square feet. So, but if you look at the investment sales side, at a little over $23.2 billion for last year, it has been steadily going down since 2014.
But we also have picked up a large number of new buildings on the far west side.
Yeah, no, there's growth. We have 16 million new square feet of new office space coming through right now under construction.
Rents have reached a higher level.
They have reached it, right. I think the real estate investment activity is going to increase across the United States and hopefully New York City too, because if you look at big pension funds from Ohio State teachers to, you know, CalPERS, CalSTRS, all the Rolex pension fund, all these, the stock market is very full at this point, right? And the investment criteria of a lot of these places has to start looking and diversifying into more into real estate. So I think there's going to be more money seeking real estate. The problem is the residential market on multifamily homes, which is really what people liked so much, has a problem, and people don't understand it yet. And so they're going to evaluate. So the activity level on the residential side, which was a big portion of our marketplace, I think is going to take a pause for a moment. And the second thing is if you buy residential, there was always a way to increase your value. You could increase rent. You could decommission a residential unit from rent stabilized if it had certain criteria. All that is gone. So you're buying a yield right now, and that yield actually could decline, not increase. And you don't even get an incentive for renovating anymore. So what you've created is a market for landlords that are going to go backwards. And I don't want to call them creation of slumlords, but you're really creating an environment where nobody has an incentive to put money in the building, to combine units, do anything like that in the market. And that doesn't help the housing. That doesn't talk about affordable housing. This is taking people who some of whom are needs, some of whom aren't, in a rent stabilized environment, but their buildings are not going to be well maintained and cared for because there's zero incentive now to go do that. In fact, you won't be able to afford to do it. And that's a big problem. So there needs to be an adjustment with the law, I think, because it was written very quickly, very short-sighted, and didn't accommodate really what I think the goals were.
Dan, with 67 million visitors to New York, and I know that your firm specializes in hospitality, how do you look at the market in New York?
The tourism industry's up. It's never been more affordable for a tourist to be able to visit New York, right? A hotel, but that's not always great news for a hotel owner. But generally speaking, you're seeing, I think, one of the market changes has been that you can now take a hotel and you can convert it because of the expiration of certain laws. You can convert it to residential or you can convert it to office if a developer wanted to do that. I think the other thing, there were some articles recently about the power of the unions, and these unions have figured out, particularly Peter Ward and the hotel union, that they can rally a lot of these the tradesmen that work in the hotels, and with all of those donations, they can have a real voice in these elections. And so I think that there is a real need to cater to what that trade group wants in the negotiation, because they really do have some power.
Kent, you're in the construction business with Falcon Pacific. How do you see the construction market?
Well, I mean, there's been a lot of activity right now. We've got two hotels that are going up on 38th Street, both on the west side. And I think the activity is very strong. Prices are expensive. I think that there will be an adjustment at some point to some of the pricing that's going on. I don't think you're going to see as much breaking ground for the moment of new construction on some of the commercial and other things until everything gets digested. You have a lot of space that's gone up, but we're seeing you have huge activity level. You look at the west side, with all the buildings now that had come out, they're virtually fully leased right now, and that's an extraordinary statement. So I'm bullish on what's happening.
With regard to that, how do you see development sites on the west side?
It's counterintuitive, although for the aforementioned reasons, maybe it's not. We can't keep, and Dan and I had spoken about this, we got together just before the Christmas break, you can't keep land on the shelf in this city. And that's not bluster. If you ask two sales brokers if we can choose any type of assignment in any neighborhood, I would tell you, give me any piece of land for construction, and not just commercial and office, even retail. People still believe in it, and even residential. And maybe it's because we have some of these laws where the unintended consequence was to halt the conversions, but I can't keep land on the shelves. And what's starting to happen is the demand for retail started off with the real retail abyss, which we were in 2018. We've climbed out of it. Landlords recognize that the $400 a foot that they were going to get on side streets in Soho is closer to $200 or $225 a foot. Well, they're leasing them up. You're going to see a lot of leasing activity this year because landlords and their lenders, as importantly, who many times have the right to reject or accept a lease when there's a projection, a lot of those lenders are saying, go ahead, we'd rather have some income. So I think you're going to see in New York, and Kent spoke about it earlier, I think you're going to see a return to a very big small city. You're going to get all of the food and beverage, all of the things, and I'm going to continue to quote Ken, what Paris looks like, a lot of mom and pop shops. Well, the good news is, even if it was the unintended consequence of legislation and the retail downturn, you're going to see a lot of new tenants in New York.
Dan, I know a couple of years ago you were very active in the boroughs on retail. Where has that happened? I mean, you had the retail component of apartment buildings, a lot of that.
So we had a few retail condos, and I don't think the market has changed dramatically. Those were difficult to sell 3 years ago. They remain difficult. You call an investor and tell them that, that they are the winning bid, and suddenly they start to question if they have bid too much. And so they're not easy deals to get done, because it's the one value add deal. So vacant retail, for example, is just a difficult asset class to convince investors. And it's not because a lot of people have a positive outlook on it. They will express a bullish nature on, yes, I do believe in this location. Yes, I do believe in that rent. You're realistic about things. But our investors have just had too negative of an experience, or we're overweighted in retail in the portfolio. We just can't make any more retail investments now.
The largest tenant of office space in the city of New York is WeWork and the co-working. How do you see co-working and co-living in 2020?
It's been fervent and fruitful for decades. Regis was one of the first major entrants.
Yeah, but they never had 4.8 million square feet of space.
No, but then they were always valued at 3 or 4 or 5 times EBITDA, which is where most other companies should have been valued. I think that you're going to see people backfilling a lot of WeWork space. WeWork was something that it was almost a running joke that you didn't even need to be somebody in the real estate industry to see it. And it looked like a Zamboni very slowly heading towards a collision with a Lamborghini. We all knew that this was going to happen. We all knew it was going to be ugly. But I think that you're going to see a lot of that space getting absorbed by smaller niche co-working companies. You have The Wing. You have a handful of new ones that are going to cater to working parents.
What about Notel?
I think they're doing gangbusters at this point, and they're going to pick up a lot of space. It makes sense.
What about co-living?
Ofer Yardeni said on your show several years ago, and I'm having a great day quoting people smarter than I. Ofer Yardeni said...
I'm really proud of you about your...
Well, this is what happens in your mid-40s, Michael. You grow up a little. Ofer Yardeni said what was one of the most comical but one of the most prescient things I've ever heard about co-living. You wait until you're in your early 20s to make enough money to hopefully move out of your parents' house and get rid of your roommates so you can keep your toothbrush out without worrying about it. Why in my 20s and 30s and 40s am I going back to a roommate situation if there's opportunity with the decline in rents other places? I don't think, other than for maybe a bunch of youth hostels and tourists, you always have shares. You have Craigslist ads, and a lot of the folks in there, the neophytes who work for me, share apartments. But the concept of it growing tremendously, maybe in Europe for tourists. I don't see it in New York.
I think that the concept of living with roommates is never going to go away in New York.
Right, it's been around for 100 years.
And co-living is being branded almost as a highly amenitized roommate situation, right? So it makes sense, and I think it speaks to the desire for multifamily developers and owners to elevate the experience that somebody has in there. So rather than just renting an apartment, similar to the hospitality industry, they start to offer things like, well, we can come in and clean your apartment. We can come in and offer you Wi-Fi. We can offer you all the concierge services. Many of these kind of amenities have been available in luxury buildings. I think that owners are always looking to try to take and elevate the experience of the building, and co-living to some extent is just another version of that.
We've hit a price point where it's too expensive to live alone in New York City for these kids who are graduating in their 20s. And they don't want a roommate in a space. Let's say you have 4 or 5 people in an apartment in a space. Each one has its own room, its own bathroom. Now, there's certain amenities you couldn't get on your own, such as a very big kitchen, a washer dryer, all these other things. So the co-living is some of the public space within it, but you go into your own room and you have your own bathroom, etc. Now that kind of co-living I think makes a lot of sense. The other thing is that a lot of the kids coming out of college for their first couple of years want to have a couple friends to kind of hang out with and live. So I think for that it works out well. The ones where they're co-living and you're just sharing rooms, I don't think that's where the end all is.
I don't think New York, so I respectfully disagree with these folks, but what I do think is going to grow, and it may be a logical outgrowth of the co-living concept, is we're starting to see some of the third-party student housing providers in the 5 boroughs relax their rules on the definition of a student. So earlier this year, we sold a building in the 100 block of 3rd Avenue for $212 million. This was a student housing building master lease to 3 universities and a third-party student housing provider. On a going forward basis, I think you'll see more of those conversions, and the definition of student may increase the age to graduate, student, and postgraduate, and there may be a wink and a nod. You may have people in their late 20s opting to be in those situations before a purely defined co-living.
Like 30 seconds left. Is the apple going to be bright or is it going to be dull?
I think the apple looks like a Macintosh. It's not a golden delicious, and it's not one of those heavy reds with the wax on it. I think we're going to have a great year just because new entrants to the market, the acceptance of the paradigm shift, the low interest rates, we have to give that a plug, and I think some of the misguided legislation is going to take a break. We're going to have a good year.
Dan?
As long as the economy keeps roaring, the city's going to do great.
Kent?
I think it's a buying opportunity, Frank. For co-ops condos right now, if you look, and the market was down, and it wasn't down because of any economic indicators or any problems. It was down because perception more. I think with the low interest rates and the market the way it is, one of the great buying opportunities for co-op condo, and the market on the other side of the commercial is going to be good.
Okay, so you're pretty bright, and let's hope it stays that way. I'd like to thank David, Dan, and Kent, and we'll see you next week.